You've talked about 0.5 to 1% for revenue as my materiality at the account balance level and all of that. How do I then get my overall material? Which one of these will be my overall materiality for the financial statements? In this question, the company is saying, sorry, the auditor is saying they will use total assets, which will be 1% of what? Total assets. Okay. Now, generally, what you should use as your benchmark for your overall materiality for the financial statement is a function of the parameter that is most important to stakeholders. That's why you have here stakeholders based. The parameter that is most important to stakeholders will influence the benchmark used for overall materiality. Very important point. I hope you guys are taking notes. Okay. Now, if the company, we believe that its key stakeholders, PBT is what is important to them, then we will use 5% of PBT. If we believe its key stakeholders, revenue is what is important to them, then we'll base it on revenue. If we believe it's the assets, balance sheets that is important to them, we base it on balance sheets. Now, typically for listed entities, you should use profits because who are the key stakeholders? The shareholders, the public, the investing public. And what will they really often be most interested in? Profit. So it is by far popular to use 5% of PBT for listed entities. So that will be your initial basis of raising an argument here that given that Payroll is a listed entity and its significant stakeholders will be the investing public, profits before tax will be the most important benchmark and parameter to them. As such, it is arguable whether they should, it may be inappropriate for them to be using total assets as the benchmark. That's number one. Sorry, can I ask someone to tell me why did I say it may be inappropriate to be using total assets for dairy as the overall materiality benchmark? Can somebody tell me? What did I say is the reason?
Because it's a listed entity.
And
The stakeholders is the investing public, so they will be more interested in the profit before tax.
Fantastic. Good. So I hope you guys have taken note of that. The benchmark to be used for your overall financial statement materiality. And that overall financial statement materiality is what makes you determine whether you will qualify your opinion or not qualify when there's a misstatement. Okay? So for the overall financial statement materiality, the benchmark to use, whether we will use revenue, whether we use PBT, whether we use total asset, is a function of what is important to the stakeholders. In fact, generally, materiality is based on what are these things that are often considered. I think when I remember, I will let you know. One is activity based, another is profit based or something like that. But I will let you know those things once I can recollect it. All right. I don't want to lose track of my focus. The second thing, please pay attention. The second thing is why use total assets when this company is more of a service provider? Total asset benchmark is more suitable when you are dealing with a company that is what? Highly asset intense. I'm sure you get what I mean. Okay, so yes, the basis I was talking about is revenue based, or revenue based, which is also called activity based. Okay, so activity based can be revenue or OPEX. You know, there are some companies that their main indicator, main factor that the stakeholders that are relevant to them consider is their operating costs. I'll give you an example. There are some multinationals across the world that just have cost centers in Nigeria or representative offices. Those representative offices, most times they incur costs to run their operation, but to justify their profitability, they work with cost plus a margin. So cost plus markup could be maybe 10% markup. So any cost they incur, they put 10% on top of that. That's how they determine their revenue. So their revenue is not that they sold products and they have selling price. Their revenue is the cost we incur during the period is 5 billion. 10% on top of that, that's their revenue. So such companies, the information that is important to the group office there is the cost that rep office is incurring in the country where it is. So it will be appropriate for the auditor to base its materiality, for example, on its total operating expenses. That's activity based. The second benchmark group is earnings based, and that's the one that is PBT. And I've told you that is by far even more popular for a lot of companies and more importantly for listed entities. The third one is asset based, okay? Asset based. And that is where you believe that what is more important to the stakeholders is the asset. You know, there are some companies, for example, so the asset base may be total asset, it may be total equity. Bottom line is balance sheet based, okay? And these earnings, it may not be PBT only. Sometimes it may be EBIT, earnings before interest and tax, or EBITDA. You know, different measures that the auditor may set. It's a function of what is important to the what? To the stakeholders. Consider a company that is not listed. Majority of its finance is provided by SHEI, which is a debt finance. And the major factor that have been considered by SHEI and that SHEI continuously monitor to determine whether it will continue to lend and provide the needed funding to the company is its earnings before interest, tax, and depreciation and amortization, which really shows their ability to generate cash flows and pay my interest and pay my principal back. So if I'm determined to be the key stakeholders, or the lender groups is determined to be the key stakeholders, and what they monitor really is EBITDA, not PBT, then the auditor is okay to use that EBITDA as its benchmark for what's the name? For materiality. What rates to use can be adjusted. It may not necessarily be 5%, it may be up slightly, down slightly. You don't need to deal with all of that in the class, but I mean, I just feel like explaining these areas further. So that's in terms of the benchmark. Now let's get back to what we were doing. So now we've talked about because to be honest, I mean, like I said, this is my first time of seeing the examiner raising practical issues on materiality. Okay, so as I've said, because it's a listed entity, you know, it may be more appropriate to use PBT. Now, obviously, you'll be saying, oh, but it's loss making. I'll deal with that. The second thing I said is it's a service provider. Is that not true? Service provider. So it may not be very capital intense or asset intense. So in that case, using, you know, assets based benchmark may really be inappropriate. Okay. Now consider some companies like WhatsApp. Before WhatsApp was acquired by Facebook, so several years, WhatsApp was not making any profit. In fact, revenue was close to zero, as giant as they are. But what was important to Facebook when he wanted to do that acquisition the number of subscribers that the company have. If they decide to monetize WhatsApp now, that everybody around the world, you must be paying $1 every month to use WhatsApp. Most of us will still pay, but imagine how much that is as revenue for them. With over 1 billion subscribers, monthly paying $1, you can imagine, you can already start calculating it in your head, how much revenue they'll be making. Okay, so for a company like that, at that time when revenue and losses were just so significant, the auditor might have used their OPEX as the benchmark rather than the losses they were making or the revenue, because there was really no revenue. I hope you get that part. All right, so let me move to the second one. Yes, obviously it's expected to be a loss-making business. Because a company is expected to be a loss-making business, does it exclusively mean that we should ignore profit benchmarks, that is, that side of the P&L as materiality level? Not necessarily. That is where the concept of normalization that I talked about earlier on comes in. Normalized figures, normalized profits. So the standard says, that's ISA on materiality, states that if you see or notice that, you know, what is causing this disruption to the entity's profits is due to one-off events or due to an event that may still unwind at a future date, you know, that you are allowed to take out the impact of such one-off event and work on the normalized profits. So normalized profit may just be adding back such huge losses that might have happened during the period. So this will mean that the audit team will need to drill down further, to see whether maybe they could have still made a profit despite the lower subscription base if there were no other things that might have, you know, that are one-off events that could have resulted in the potential loss that they are expecting. Now, if after doing that normalization and drilling down and you found out that a loss is still expected, then it may make more sense to revert back to what? Revenue as the benchmark rather than using total assets. Because as I said, it's a service provider and it's a listed entity. If the shareholders are not interested in profit or the losses, at least they will be focusing their eyes on revenue, because that's the main driver of what? Profit. And that's not likely to be negative. Okay, so I hope you get that part. Remember, if you have a question, you can always ask. Now, level of materiality given the risk. So now another thing they may need to consider is the risk inherent in this audit. Okay, so the risk inherent in this audit is potentially high risk. Can't anybody tell me what are the possible reasons why I might have tagged it high risk?
They are not using IFRS.
Yes, good. What else?
We have to depend on the work of others. I mean, the use of a component auditor. That's an inherent risk itself.
That I may need to be careful. Remember, everything we are looking at is still from the perspective of the component auditor. We are evaluating the work done by the component auditor. So this from perspective of component auditor. I think why I am concluding that it's a high risk is this. Number one, now, it's facing difficult trading circumstances. Is that not true? Sorry, just 1 second. Yeah, so it's facing difficult trading circumstances, difficult trading conditions. Okay. Number 2, it's a listed entity. Don't forget that. It's a listed entity. Number 3, it is loss-making. Combined with the fact that it's listed, makes it high risk, okay? Now, what do we normally say when the risk is high in terms of the impact on your level of materiality? Lower materiality or higher materiality?
Lower.
Should you reduce your materiality level or increase your materiality level?
Reduce it.
Reduce.
Lower.
Reduce your materiality level. Now, they said in the prior year, the materiality threshold they used is what? 1.2 million. But in the current year, what's the materiality threshold that they want to use? 1.4 million. What have they done to their materiality level? They have increased it. Is that consistent with the higher risk assessment? No. So you've got to talk about that. So the level of materiality set given the risk is inconsistent. Okay? Is inconsistent. Typically, when you want to start a year, the company is listed, they are suffering, they are facing, loss of revenue, they are loss making. You want to drop your materiality threshold because they have a greater incentive to engage in accounting bias. Overall, anything that you do in terms of the basis and conclusions around materiality must be documented. The basis for setting it and the conclusion, what your materiality threshold is. Conclusion, that's your conclusion in terms of materiality, must be what? Documented. Materiality must be documented. Okay. All right. Any question? That took me longer than expected, but I hope you were able to pick a couple of things there. We talked about the various benchmarks that can be used. We talked about the fact that auditors typically set materiality at the overall financial statement level. Then we said that judgment is usually required, determining what percentage to use, what level to set your materiality, and what benchmark to use. And we said that because it's a listed entity and because it's also a service provider, it may not be appropriate to use assets as the benchmark. Then we said they can go back to the POL and consider normalizing the expected results such that they may have a normalized profit. But if it is impossible to do so because there have been a fundamental change in circumstances, then they may go back to continue using the revenue benchmark that they have been using because this is a service provider, right? And then we also said the level of materiality set is not consistent with the risk. The risk seems to be higher this year. They should ideally lower their materiality. And whatever you do, you must document it. Okay, so let's move to the next audit strategy area. It's really past time, but I'm not seeing that you guys are leaving. So I don't know. Can I continue or we should just wrap up quickly? Payroll. What are your thoughts? Payroll. I hear somebody say, "She stop waiting for point. Time has gone. Just pour everything and let's go." That's not my tradition. No.
Okay, so hi Sheyi.
Hi,
So
go ahead.
what they are doing here is so they are the one that prepared the payroll. So they didn't see any reason to review what has been prepared. So this is a self-review threat. So the audit team should take their time to review the payroll to be sure that there is no mistake or error in the payroll computation.
Fuel has finished.
People has finished too.
Oh yeah, John, come back before you go. Say this after me. I I will not
I will not
give labels again.
give labels again.
I will explain the threat,
I will explain the threats,
evaluate the threat,
evaluate the threats,
and discuss possible actions in terms of safeguards.
and discuss possible actions in terms of safeguard.
Thank you. So now, you told me there's a self-review threat. Bravo, brilliant. Once you've been able to identify the threat, finish the journey. It's just like you collected the ball from the back. You dribble, got to the post of the opponent, dribbled the keeper. It's time to score. And then you left the ball there and you went back to the back. Okay? So you've identified the threat. You've said a self-review. Explain why it's a self-review threat. Okay? They may not identify errors in the work that they have done, even if at all they decide to review. Now, the decision not to review means that they are not approaching the audit with an attitude of professional, skepticism. Yeah. So then you go on to talk about, if you had evaluated, you would have checked materiality, for example, because they said total payroll figure is expected to be 6 million. So is it significant to the financial statement? If you had evaluated, you might have talked about the broader ethical issue. Can you provide payroll services to a listed entity, the subject of which is material to the financial statement? John, you see where I'm coming from?
Yes.
So you know that ISBA code generally says that what? Okay, so since John has said the context and we don't have a lot of time, let me just, go ahead. What the code says is this. The independence requirement. Actually, it is not the code, it's auditing standard that says this. The independence requirements that applies to the group auditor also applies to all the component auditors. Okay. Wait. Okay. I think we dealt with it. The independence requiremement that applies to the group auditor also applies to the what? The component auditors. Now, what am I saying? Where a component auditor is operating in a country that has less stringent independence and ethical requirements, that component auditor, for the sake of that audit, must comply with the more stringent one, which applies to the group auditor. But if that component operates in a jurisdiction where its own ethical requirements and codes are more stringent than that of the auditor, then it should continue to comply with that one. Now, we don't know whether provision of payroll services to listed entities is allowed in Farland or in the jurisdiction where they release. Okay, but certainly we must know for the group auditor because we are the one doing the exam. What does the ISBA code say about providing payroll services to a listed entity? ISBA code says that an auditor is not allowed to provide bookkeeping and accounting services, which includes payroll services, to a listed or public interest entity, unless in emergency situation. And even in that emergencies, they are extremely rare cases. That is now further compounded by the fact that this payroll figure may even be material to group profits. Abi, how much is group profits? Let's go back and check. 60. So it's almost 10% of group profits. So if you've taken it from that angle, there's no way you will not have killed the entire point in that area. I think I have something on my next slide. So good. So you talk about the threats, you see, payroll, significance, and threats. Okay. So you talk about the fact that it's significant, almost or about 10% of group PBT. Then you explain the threats, you apply our normal distance. You explain the threats. What can go wrong as a result of providing such services? They said from this, payroll services was provided